Good evening. Welcome to We Mean Business. I'm Anisha Nair Dhawan. A spate of recent reports have shown that India's growth has slowed down sharply and manufacturing inflation has come off significantly. Add to this the fall in prices of gold and crude oil, two big contributors of our import bill, and the optimism of further rate cuts from the RBI has started to increase. This despite the RBI saying in its March meeting that headroom for further rate cuts were limited due to inflation remaining uncomfortably high. Can the RBI move in with more aggressive monetary easing? Will banks be able to pass on the lower interest rates to borrowers? And will this stoke growth? To discuss this, I am now joined by Arbind Prasad, Director General of FICCI. We have with us Mr. Shankar. He's an independent economist and political strategist. We also have with us Mr. Viney Kumar, Executive Director of IDBI Bank. Soon we'll be joined by Mr. Ajay Mahajan, Managing Partner at R Square Advisors as well. Welcome, gentlemen, to We Mean Business. Let me start with you, Jay. Do you think the situation has changed drastically from March when the RBI said that it has limited headroom to be aggressive in its monetary stance? Has the situation changed quite a lot since then?
Well, not really, Anisha. If you look at the inflation numbers, headline numbers for sure, then you may get that feeling. But there are other indicators which are telling us that the situation has not really changed much. And mind you, we had 70 basis point revision in the January number. So the numbers which we have seen, the headline number now, they are most likely to be revised upwards to something like another 50 or 60 basis point. Now even then, you would argue that 6.5 or 6.6, the revised numbers would be almost meeting the RBI's March end target itself. Having said that, let us also look at the CPI numbers and also look at the current account deficit, which actually decreases the elbow room available with the Reserve Bank of India to actually go on a very aggressive rate cut. All these things, I think, also point to the other point of view remaining that the rate cut is necessary to boost investor sentiments. Now, if you balance out the views for and against rate cut, what you are likely to arrive at is that you will get a 25 basis point rate cut. However, you would know that even countries like Brazil, they are likely to hike rates now rather than cutting rates because of the huge amount of liquidity inflow that is likely to happen thanks to the Bank of Japan's last week's announcement of a large monetary easing. Now that is still to be seen in the markets, but I would suspect that the RBI would be very, very careful and would be taking very measured steps. The statement may be very aggressive, but the steps may not actually reflect that.
Right. We are joined by Mr. Ajay Mahajan, Managing Partner for R Square Advisors as well. Mr. Mahajan, what is your expectation of the RBI in its May meeting? Some people feel that the RBI can be aggressive and cut rates quite aggressively, not just the repo rate, perhaps even the CRR rate.
My view is actually a little different from the previous speaker. I believe that time has probably come now to take a very strong look at the growth dynamics in the Indian environment, considering that we are faltering below 5% now for 2 consecutive quarters. While there were concerns about wholesale price index inflation and CPI, and nobody can wish those concerns away at a time like this where CPI is ruling at double-digit levels, the fact is that core inflation in India, which is what RBI has in the past, at least policy framework, looked at more as opposed to CPI, has slowed down sharply to 3.5%. And that's possibly thanks to largely to global commodity prices coming off, metals, mining, those prices coming off more than food. And food remains a big concern, of course, barring some softening in prices in vegetables in the previous month, which has probably brought down primary food article inflation a little bit. the fact remains that the divergent trend between WPI and CPI is here to probably stay. Also because the government is passing on all the subsidy decontrol now, so that basically reduces the consumer's disposable income, and that is going to definitely reflect in CPI for a while. So the point is that inflation is here to certainly be a little more sticky, and it will take a long while. Certainly the consumer inflation will take a long time to correct downwards, but the inflation at the WPI level has certainly eased, and RBI will probably take cognizance of that. On top of that, I bring the external account, which is certainly likely to look better. We all know the numbers of the quarter ended December at 6.7%. That obviously looked very large. But my view is that, with the way the global commodity prices, particularly precious metals like gold and silver, have melted in the course of the last 2 days, and that doesn't look like, prices correcting back up in a hurry. On the contrary, I think all rallies will probably get sold into for the short term. That augurs very well for the Indian external trade account. And I think while, all the problems can't be wished away just because gold prices have come off, the fact is that crude has also come off and Brent is trading below $100, and that augurs very well from an external trade account point of view for conditions to be reasonably good for Reserve Bank of India to probably go 50 basis points and not 25. So I remain in the camp of an aggressive rate cut in May, and a follow-up of that further down the year by another 50 points at least. So I would think 100 points between now and the year end is our prognosis.
All right, 100 basis points rate cut by the RBI from now to the year end is what Mr. Mahajan will be looking forward to. Mr. Arbind Prasad, rate cuts have not brought down consumer inflation. So it has killed growth in the interim. Will rate cuts then revive growth?
I would fully agree with Ajay Mahajan's analysis that the RBI will seize upon this opportunity where there is a fiscal consolidation, many other measures taken by the government for the reform. And now that inflation coming down, there is a huge expectations from the industry for the aggressive rate cut. I would expect the same 50 basis point and then another 50 basis point over the years to give the total boost to the growth, because you would have seen over the years the growth has gone down, and that has related to that meant a very slow down in new employment creation. So the current batch of youth coming to the job market are the really sufferers, and therefore I think the RBI will take upon this opportunity, given that the government has taken its part of the activities, increased the reforms, CCI Cabinet Committee on Infrastructure Investment has been meeting. They are taking steps. So this is the right time for the RBI to give the very aggressive signal that they want to boost the growth and create new employment. And I fully agree, without repeating all the facts or the analysis that Ajay Mahajan has given. I am of the same view which Ajay Mahajan has elaborated.